Do you still find it weird listening to yourself?
I'm sort of used to it now.
Yeah.
I
still find it weird.
I'm starting to get used to it. Honestly, I don't think I sound that great when I listen to myself.
No one does.
But I don't think I'm minding it anymore.
You know, it's weird. The way we hear ourselves in our head is different.
Exactly.
Exactly.
And you know why?
Things. Because it's vibrating within you and all of this, so you're never going to hear yourself the way others hear you.
Your voice is still also being transmitted through your body.
Exactly.
Through at the same time you're hearing it with your ears. So it's
so
a bit
weird.
of it's like a surround system, You're getting it. There's a surround effect. But other people usually hear it one-sided, unilateral, yeah.
So I don't know. Every time I hear myself, I'm like. So when I watched an episode with Sandra, like where I was reviewing that. See that?
Which one?
That sounds so weird to me.
Yeah.
I'm like, and yet Sandra, when she's in the other room, she's like, "Are you talking to me?" Because she knows that's how she hears me.
Oh, okay.
So then we're watching it,
and
I'm like, I actually hate listening to myself. I prefer when Tim's speaking.
Yeah.
Also, there are times where I realize there are things you say that I don't pick up on because we're so in the moment. I'm like trying to figure out what I'm going to say next, how to, take what you're saying and move it into the next point.
Yeah.
The times when I only hear a really good point you made.
Yeah.
When I'm watching the video.
Oh, you're like, wow, that's
Tim's a really sharp guy. That was really cool. It's so funny. Like that's actually when I get to fully.
Yeah.
Fully appreciate what we did.
Okay.
Yeah, and I'm like, okay. Sometimes I also see I had a thought I was going to finish, but then you said something and I went off in a different tangent.
Yeah.
Yeah, so it's
okay.
Little things like that I realize only when we watch it back. But
it's okay. We can note those things down and see how best we can maybe improve on them,
Yeah.
But overall, the funny thing is actually enjoy listening when you're like I'm listening back to the episode.
Yeah.
When you're speaking, I'm listening much better. When I start speaking, I'm like, okay, fine. What is this guy saying?
But we're always harder on ourselves than we are on others.
On other people.
I saw a thing about that. Like when you're going through something and you're really struggling and you're being tough on yourself.
Yeah.
Imagine it was someone else, a friend of yours. How would you treat them? Right?
I would have shown them so much grace. Come on, take it easy.
Yeah, exactly. But when it's
like when I have a bad day,
like
if you play golf and you have a bad day you're struggling with hole number 1, number 2, number 3. You're so mad. Like by the 4th hole now, you're starting to wonder what's this.
And you're hard on yourself.
Exactly.
But everyone around
but if it's somebody else,
relax.
you would be telling them, chill, man. We only started the game,
So you already started giving us wisdom from the course before we started.
That's on you today. So.
Hi, and welcome back. This is the Full Scale Podcast, episode 8. My name is Adrian Twatwa. I'm joined by my friend, colleague, and co-host, Timothy Mukiti. Hi, Tim. How are you today?
Good. How are you? Episode 8.
Right?
Quite some progress, huh?
80% done with season 1.
Yes, 80%.
We will be after this episode is done.
Yes. Once we are, but we have we're halfway there,
Right?
The fact that we've started. Yes.
Yeah. So awesome. Very happy to be here. Thank you for joining us. Thank you for viewing, listening, wherever you are. Hopefully you'll get some good value out of this episode. So let's get right into it. Today we are talking about the investors. So we've spoken at length about startups, founders, funding cycles, etc. We thought it would be good to take a moment just to recognize who are the investors that work in this ecosystem, the role they play, what they're looking for, and just do a bit of a deep dive on them specifically. So it'll be an episode that gives you, if you're a founder, it will give you more insights into how investors operate and what they're looking for, how to approach them, sort of ways that you should be dealing with investors. From an investor perspective, you'll probably already know most of this, but hopefully it will give you good insights into other investors across other asset classes or just other people working in the same space. And anyone else who's viewing, hopefully you find good value in it and it's something interesting. And share with a friend.
Yes.
So let's get into it. So we're talking about investors today, Tim. Let's start very basic. What is an investor? What is an investor and what do investors look for? What is it that they are trying to achieve when they make an investment?
Yeah. So an investor is, of course, someone who puts their capital or resources. They do not necessarily have to be monetary resources, but it's a person who puts their resources into something in the hope of a return. So it's an investment because you're hoping to get a particular form of return out of the investment. So investors are typically looking for different types of returns because not all investors are driven by the same goals. Some investors, of course, will be driven by the need to make an impact. There could be a need to make an impact or do some social good, or contribute to economic development, especially to disadvantaged communities, or maybe just to add value within the society. That could be a driving factor for some investors. Other investors are driven by financial return. You're investing because you want to get your investment or your capital to grow maybe 10 times over or a couple of times over. So that will be what would be driving you. Other motivations or something that would be driving an investor could include strategic value of the investment that you're making. And strategic value, when we look at it in terms of a startup, could be that this particular startup or this particular company is doing something or has come up with an invention or has innovated in a particular area that adds value to your business in the long term. Maybe for example, if you're in the transport industry and this startup has come up with, and we're assuming you're in the transport industry and you're doing the traditional transport, maybe you're running an airline. And then there's a startup that has come up with a system or a product that helps in ticketing, makes the process of ticketing much easier. You're more likely to want to invest in that because there are some synergies you can get from investing in that particular startup. You can perhaps get the product at cheaper, which would help in building your business. So those are by and large what would be the motivating factors for investments. And it's good for a startup really, or a business, to understand when they're looking for investments, what perhaps is the driving motivation of a particular investor. Because if you're looking for investment from an investor who is keen on growing the investment, making money multiple times over, then you have to know that you have to really work hard to expand, to scale up in order to make the investment valuable and have good returns on the investor. If, for example, if it's an investor who is looking for impact and you're a commercially aligned startup, your goal as a startup is to make a lot of money, turn around the startup and make a lot of money, then you may not be very well aligned with an investor who looks towards making an impact. And you have to be, to properly balance that. However, I also have to say that despite the varying motivations, there is also some overlaps. Because some investors will still want to make a healthy return on investment in terms of making good money out of it, but while at the same time making an impact. You've heard of terms like purpose-led businesses. Your business is not only making profits, but it's making an impact in the society. And largely that's the sweet spot. You'd want to be making an impact while at the same time making profit out of it.
Double or even triple bottom line, right? So
exactly.
Making returns for the investors, but also helping socially and development. Totally makes sense. And also I think just to add that it might also help making sure you're aligned with what your investor is looking for will also help in the way you pitch them. So if you go to pitch for an investor who's super focused just on returns and they don't really care about social good. If your whole pitch deck is about the social good, you're going to, it's a bit misaligned. They might not really care for that as much.
Exactly. That's very true. It helps to know what your investor is targeting so that you not only, even not for purposes of pitching, so that you can understand whether you are likely to be aligned going into the future. Because you might need capital, yes, urgently, but if you probably mislead the investor by tailoring your deck towards a particular direction, and then when now it comes to the operations, they're asking questions on how much have we sold, how far, and you're telling them stories of we helped a kid go to school, then you're getting misaligned. And it's not a bad thing to help a kid go to school.
You've talked about what investors expect or what they're usually trying to achieve, as well as so they have, social impact, different things that they're going after, but typically returns. Because I mean, even if I'm making social impact, I think that's great. But I think in order for it to be a sustainable business model, the investments I'm making need to be making some type of return. Generally, I think, unless you're doing a philanthropic type of thing. So since you've covered that, now I think you were telling us about the fact that much as these investors are looking for these things, they also have options, right?
Yes, indeed. Investors do have options on what investments they can make, including investing the money in the government securities, such as bonds. They could invest in corporate bonds. They could invest in the securities exchanges, stock markets. And those are a couple of the options that the investors would have. So perhaps it's even like important for the startups and the founders when they're raising capital to acknowledge that the investors are not out of options. This is one of the options that they are taking. Yeah. And that means that for you to get that capital, you have to work very hard to convince them that it's worth their time to invest their capital in your startup, and equally to be grateful for the capital that you get. Because the investors could have, basically it's to respect the capital, not to imagine that it's just capital lying around to be given out, to realize that you better use it for good use, put it good use, so that you get good returns.
Yeah, you're not entitled to the funding. And
exactly.
I guess to make sure that you can match the returns that the investor is looking for, if it's returns or the type of social impact or strategic benefit that the investor is looking for when they invest in your startup.
Exactly. There are, of course, different types of investors that invest in startups throughout the startup, the startup journey. Do you want to take us through that? Maybe kick off the discussion around the specific investors that we have.
Sure, I'll go through them just to highlight that we've spent some time speaking about some of these investors, specifically I think in episode 3. Yes. Episode 3 onwards. So do check those out, because I don't want us to spend too much time going over retreading things that we've already covered in previous episodes. But for completeness, we will go through each of these to some degree. Yep. So I think we'll start again with our our favorites: family, friends, and what was that term?
Alternative sources closely known to the founder.
Wow, that's a mouthful.
We're the fools, really.
So yes, family, friends,
but we explained why
those folks.
The term is fools in episode 3.
So
we do not want to offend anybody. Please, you can check, but really it's usually the reference. The FFFs, friends, family, and fools.
Yes, and as we discussed, those are people who, they could be your friends, people you've grown up with. It could be your family. It could be someone that just identifies you and sees something in you as a founder. Again, speaking to the importance of the founder and people investing in people, and they want to take a shot on you, or they want to support you in this endeavor that you're starting. So you have this crazy idea, your startup, your fitness app, your thing, and you're building it, and these are usually the first people to invest in you. Of course, we should also mention the founders themselves are often investors in their own business in a way, because most of the times you'll find the founder has bootstrapped to a certain degree. I think it would be odd to me if you've started this company, this startup, and you haven't put money in it yourself, right? I think you would need to have some skin in the game. So I know that we're all fully aligned. So I guess the first true investor is yourself as the founder. You start up and you are the very first person to put money in the business when you're bootstrapping. But then we go into your family, friends, and alternative sources of financing close to the investor, the
founder.
Wow, I'll never get around that. So those are your FFFs, right? Maybe you can talk to us a bit about angel investors.
Yes, we at the early stages of investment in a startup. So other than the FFFs, they are angel investors who are typically wealthy individuals who can provide the capital to startups at the early stages in return for equity. They expect to get some equity, and in the hope that that the startup is going to grow multiple levels, is going to scale up significantly, and therefore their investment will get a good return. Ordinarily, angel investors are people who properly understand the startup space. The people either have invested in other startups before or understand the idea that the founders are trying to come up with. Like the moment they listen to the idea, it resonates, and they know this one is going to be a gold mine. So they're basically seasoned investors around at the early stages of a startup, and they're actually guys who just do enjoy investments as a career. So they make good money out of it, really.
Typically they're already wealthy,
of
right?
course,
because otherwise they wouldn't be in making these types of investments. They're what usually quote unquote sophisticated investors in the sense that they may be individuals, but they have a level of understanding of the space, and they have sufficient capital as an individual that they can make these bets.
Yes.
An angel investor, I wouldn't say just a friend that I've met who maybe has a bit of cash. I wouldn't just say that that's an angel investor. I think there's a certain level of sophistication you need and understanding of this space. Otherwise, you could lose a lot of money.
Exactly.
So that's why also some of these investment classes, you'll find that there are restrictions. They'll ask, are you a sophisticated investor? Are you a qualified purchaser? That's a term of art used in specific jurisdictions where you have to make a certain amount of money or have a certain amount of money that you have in reserve, and a certain level of sophistication to make sure that you understand the risks involved. Because again, if you're investing this early in these asset classes, you need to be able to withstand that type of loss, because you could lose a lot
it all.
of money.
Yeah, exactly. And again, they're equally investors that have a sense to play the long game.
Yeah.
You cannot just be expecting quick returns, because you have to sit it out a bit, wait for the startup to grow, perhaps raise a series of capital, a couple of series, and then you exit at some point. So they have to be wealthy to start with. But it's an interesting space. If somebody has a bit of capital to spare, literally somebody could explore this space, because it does make some good returns for a lot of guys who play in that space. But then you have to be smart enough to understand how startups work, and equally be able to interrogate an idea to know whether it's actually sensible or it's not. I mean, otherwise you'll fall in the category of the other F.
Do you want to give us some examples of angel investors?
Well, one of the examples is Mark Andreessen, who is co-founder of Andreessen Horowitz.
Horowitz,
Horowitz. That name is difficult. Was one of the early investors in Twitter and Pinterest and LinkedIn.
Yeah.
We have Peter Thiel, co-founder of PayPal, who has invested. He was one of the first investors in Facebook, and has invested in other successful startups. We have Tim Draper, founder of Draper Fisher Juvetstone. His early investments include Tesla, Skype, and Baidu. So these are some of them. You can read up a bit on these specific angel investors, how they have made investments, and perhaps get an insights in case this is an area of investment somebody would be interested in.
And you see these guys won really big, coming in early on Facebook.
I'm telling you.
So again, it speaks to there are many promising young startups on the continent. If you can identify one and really, understand their business model, really test it out, make sure that you understand the space and you have enough money to risk in this type of asset class, you could be one of the first people investing in something that's going to become really huge. And that's really where the returns are really massive, especially if you come in this early as an angel investor. It's
massive, but you still have also to understand the risks. Correct. So that's why you're required to be sophisticated. And clearly you can see the kind of investment the founders you've mentioned invested in, and how they turned. I'm sure there are other investments they made that didn't quite grow as much.
Of course.
But the fact that they invested in things like Tesla, Skype, you can tell in ideas like Tesla and Skype, you can tell they had some sense to understand that kind of market and what's happening in the near future. And I do think the continent actually could benefit a lot from this particular segment of investments, angel investors, because I think we have a good number of wealthy or high net worth individuals in the continent that could actually benefit from investing in early stage startups, especially the ideas that we have in the continent. A lot of ideas are coming up in the continent that are solving problems within the continent. So it would be an exciting asset class for them.
I completely agree. And I think, I don't think it's controversial to say that the largest return you could possibly make would be in one of those types of ideas.
Yeah.
I think that would make you way more money overall than real estate, than
Government
treasury bonds,
yeah,
that type of thing in the long run. So I think there's a bit of a misalignment there. I think we do need more peoples. And if you're watching and you're a high net worth individual on the continent, or in the diaspora, and you're interested in this region, we highly encourage you to take a look at some of the startups that are coming through.
Exactly.
And I think just to mention that a lot of those people who start out as angel investors then end up going and doing it full time, as you said, or they set up a VC fund, which is sort of the next category of investors that we wanted to talk about.
Yes.
So venture capital funds, as we've mentioned in the past, it's they pool capital, they pool funds from different investors, and then they now form a fund. And then that VC fund goes off and makes investments in typically startup, very early stage investments. The goal is, again, to make many bets. And the hope is a few of those will really hit big. And they will, the returns you make on those few investments that really work out will cover and even compensate for all the losses that you may make on other investments that don't work out. So it's a pretty cool asset class. A VC is a lot more prevalent on the continent than, say, private equity, I think, because of the younger stage in which a lot of the companies on the continent are at. And I think they're a big source of investment capital on the continent at this point. Maybe I'll just give a few examples, specifically African ones here, because I think for the angels, we would have loved to give African examples, but I think we hesitate to name specific individuals. We want to see more in that space, so that maybe you'll be the person that we feature on the Full Scale podcast as the biggest angel investor in Kenya,
or in the African continent.
You should look forward to that. But so VC funds on the continent, Partech Africa is a big one. They recently raised their biggest fund yet. So they're based in Dakar. They've invested in things like Trade Depot, Wave, Wave, the money remittance company. Their recently closed second fund was $300 million, which is the largest Africa-focused fund so far. And they typically invest from seed to Series C, which again sort of aligns with what we're talking about, those really early stage investments. We have the Savannah Fund, which is a seed capital fund. Seed capital funds being VC funds that are specialized and focus on the seed stage of startups. So as we mentioned, you come up with your initial idea, and then you're sort of in that seed stage where you're trying to figure it out, test it out, make sure that there's a market fit, and then go on to start scaling this idea. So the seed stage is very, very early on and quite risky. So it's really cool to see VC funds targeting specifically that stage and coming in even earlier and potentially making even bigger returns from having come in so early. So their ticket sizes are in the 50,000 to $1 million USD range, and they invest in high growth tech startups in sub-Saharan Africa. We have Novastar Ventures. Some of these are pretty household names. They have an $80 million fund that's focused on East and West Africa. They've backed Paygo, Moneypoint, Django Capital. Django Capital is another VC fund based in Tunisia. So there are a bunch. I don't know if there's much more on VC funds that we haven't already covered, especially in previous episodes.
Yes. I think we've covered it, on previous episodes as well. And even this, I think you've provided a good background on the VC funds. Sorry.
Awesome. And I think the only other thing to add in terms of VCs, they don't usually look for control of the company. They're more coming in to provide early funding, provide maybe some strategic benefits in terms of networks and mentorships and things like that. But they're typically they're not like PE in the sense that they're going to come in and take control or have significant rights in the way that the companies run. But maybe you can tell us more about private equity as another investment type of investor. Yes.
So private equity, on the other hand, invests generally in more mature companies.
Okay.
And some startups, once they have gone through a couple of levels of growth, they start now to attract private equity capital. And this is usually the investment is usually larger, larger compared to the investments that you're getting at VC. But they seek to get some form of control. And the entire idea is, at the private equity stage, you're looking at a business or a business that have sort of grown through the cycles, has matured, has a balance sheet that you can review, a couple of income statements, well, audited financial statements of a couple of years, and that you can review the performance of the company, and you can tell, based on our understanding of the market, this company can really grow. We can turn it around and grow it multiple levels, and as it grows, then our investment grows with it. So so that would be the typical investment done by a private equity fund, which is they look into the company, they think it's a good idea, it can be the company could expand, either attract new market or do business better, deepen some skill sets or deepen in a particular area, expand to new regions. And in that way, by expanding or growing or reaching a broader market, then it's able to make more money. And in return, the investment that the private equity fund has made grows with it. So that's slightly different from the way a venture capital would approach it. Because venture capital, at venture capital stage, you're investing ideally. Of course, there are some differences. Not every VC fund will approach it that way, or
Correct.
PE fund. But generally, a VC fund would be investing small amounts of money in multiple companies, expecting that the few that will make it so big that will cover some losses that you might make in the other companies. And again, at that stage, you're not able to take control or be able to take a lot of control in the running of the business, for the reason that you would stretch yourself thin. You can't manage. But a PE fund could invest in like 10, make 10 or so investments, which means you can be a little more involved, sit in the board, or you review financial statements, or even recruit somebody within who you're happy with their skill set to be able to run the finance department or something to do with strategy. And that sort of makes your ability to run or be in charge of the direction of the business much better. And even through the reserved matters in the shareholders agreement. I think we discussed shareholders agreements in one of our previous episodes. You would want to have, for PE fund, you would want to have some reserved matters so that it still gives you some form of control. So you could get control either by acquiring more than majority of the shareholding, or you could get that by having minority shareholding, but at the same time having some reserved matters. Or both. You still have majority shareholding and still have
ideally
reserved matters that enable you to sort of control.
And I think PE funds do end up then entering into more structured and sophisticated documentation, I think, for their deals, because I think a VC fund would be happy with a safe or a very short form convertible note,
VC,
that type of thing. In the VC space.
But
I would imagine when you're at the PE stage, if you're trying to get control of a company with a really significant balance sheet, a safe is not going to do it. A convertible note, you're sort of now dabbling in a lot more sophistication at that point. So, and I'm sure those guys are well represented. But if you're out there and you're starting this journey, make sure you seek legal advice, because this is not legal advice. Make sure you talk to your legal advisors, you talk to your professionals, and make sure you get the right advice for what you're doing and for your situation.
You also expect to see very broad warranties at the stage of a PE fund is investing, especially from the founders. You know, they want to see massive, clear protections in terms of warranties that this business is doing well. At VC stage, you may not ask for as much, because there isn't much to give anyway.
True.
Probably,
even the due diligence. And I was sort of reading up more on this. So on the PE side, of course, it's more you're doing DD on the company to make sure that you fully understand what it's about, what's happened historically, what assets and liabilities there are, what you're taking on by taking potentially control of this company and trying to turn it around. From a VC space, there's not as much to due diligence on the company because it's only been around for, let's say, a year, 2 years. It's at the seed stage or very early in its life. So there's not as much on the company itself to diligence. So I think they focus a bit more on the diligence of the industry. So it's if you're doing something in, let's say you mentioned an example for ticketing, right? If you have a startup dealing with ticketing, I think, and you're very early on, most of the due diligence the VC will be doing is around that space. So how much money is there in the ticketing space? What's the potential value in this market? What's the room for growth? What are competitors doing? So I think their due diligence is a bit more spread out as opposed to the PE one, where it's really you're drilling down on this specific company, perhaps also to a certain extent the market, but it's really on this company itself.
Exactly.
Yeah.
And even VC stage, you could also be drilling down on things like IP ownership.
True.
Because that's crucial to the
founders as well.
The founders as well. But this at PE stage, there's already a company to look at.
Yeah.
There's perhaps some of the companies. I mean, at PE stage, sometimes investments in companies that have been around for almost 40 years, sometimes 30 years, 20 years.
Yeah.
So these are business that have been going around for some time. They've really seen it all. Yeah, they're sort of mature. Yeah. So some of the examples of some of the PEs that are investing in the African continent or in Kenya include Adenia Partners, Amethyst, Actis, and Alethea IDF. Yeah,
Alethea IDF I think is cool because it's a gender lens focused fund. It's one of the first ones. I think they're really pioneering in that space. I heard the general partner of that fund speaking at a conference once, a really impressive lady named Tukunbo. And she's so it's the thesis being, if you invest in companies that have women representation, are led by women or co-led by women, or have women in leadership, there's much more diversity in terms of the ideas that you're receiving and the way that the companies run. And I think based on her statistics anyway, there's more likelihood of success in some of those companies than in a company where there's less diversity, especially when it comes to gender. So pretty cool ideas. But so you'll see even within PE, different funds will have different focuses. So I mean, hers, I'm not sure what I think it's basically, I'm unsure now in terms of what type of companies they're looking at. I know they have the gender lens focus, but you'll find private equity funds that are focusing more on, let's say, technology, or they're focusing on agriculture, or they're focusing on healthcare. So they could have different verticals.
Or education.
Or education.
Yeah.
Or a lot of the times, initial fund managers, their very first time out, they'll have a flagship fund, which is just, this is our first fund. So if Mukiti and Adrian made a fund, we could make it Mukiti Ntwatwa Fund 1.
Yes.
Right? And that's the fund that we're going to invest in everything that we're familiar with and that we think is going to do well. But maybe we'll have one healthcare investment that's really taken off and doing really well. And we think healthcare is the next big thing.
Yeah.
We could then 3-4 years in set up a new fund, which is Mukiti Advocates Healthcare Fund 1.
Yes.
And that's going to be doing just healthcare investments.
Exactly.
And probably will have similar investors. But then Fund 1 will then have Fund 2, Fund 3, and sort of those funds, the flagship funds, will still make agnostic investments or investments across different sectors.
Exactly.
But you could have specialized ones. Similar even in the VC space, you could have a bit more specialization.
Exactly.
But
exactly.
Just to give you a sense. And I also find it weird that, well, maybe not weird, but a lot of these PE funds, at least the ones focused in Africa, their names tend to start with A. Is that a branding thing? So we talked about Alethea, there's Afrikinvest, Adenia, Actis, Ascent Capital here.
Wow.
So
that's actually an interesting one. We need to understand why.
I don't know what it is.
Wow. Okay.
Maybe
that's
interesting.
interesting.
It's like Africa.
Yes.
I don't know what it is. But a lot of them end up starting with the letter A for some reason. Anyway, that's neither here nor there. Should we talk about strategic investors?
Yeah, please take us through strategic investors,
Sure.
Yeah.
So strategic, let's so we've talked about friends, family, VC, PE. Largely, those investors are typically looking for either financial returns or they're trying to make some sort of social good. They're trying to create social benefits, economic development in the region that they're investing in.
Yeah.
Or the people that they're investing in. Strategic investors are a bit different in the sense that a strategic investor is making this investment. I mean, they're hoping for financial returns, yes.
Of course.
But I think the primary driver for them is there's something that they see in your company that is relevant to their industry or to what they're doing. And I think you already gave us a great example for this in terms of the ticketing example, right?
Yeah.
So you have a big corporation that does airline transport or train transportation or something in that. Or maybe they host concerts, right?
Yeah.
And now you as a startup, you've come up with this new ticketing way, a way for people to buy tickets that's seamless. They can use M-Pesa or whatever.
Yeah.
It's really quick and nifty and it's novel and it's scalable. It's all the things we talked about in episode 2. as a strategic investor, I might be a huge corporation. I'm not a VC fund. I don't typically go make investments. I'm in the business of airline transportation or concerts or whatever it is.
Yeah.
But I say this little startup, what they're doing could have such a huge benefit or huge bearing on our industry that I think it's worth investing in them early enough.
Yes.
So that once they do make this huge revolutionary change in the market, I'm already invested in them, or maybe I already own them as a company, as a subsidiary. So that's sort of what we're talking about when we talk about strategic investors. We also refer to sometimes as corporate venture capital or corporate investors. So you see a company going out and making an investment in a startup in a way that will benefit that company in the long run. And of course, also benefits the startup. So I think the example that I really like that's pretty relevant now is we're seeing this play out in the AI wars. I guess they're already calling it the AI wars in terms of someone has to win. So someone won, I guess, in internet.
Yes.
Someone won when it comes to e-commerce and Amazon. Someone won when it comes to search in terms of Google. So who's going to win in AI? And everyone's really racing to make sure that they're the ones who win.
Exactly.
So 3 big contenders for that top spot are Microsoft, Amazon, and Google. Right? So you think Google made an investment in DeepMind. DeepMind was an AI shop, like they do AI technology. I'm not gonna act like I actually know what DeepMind does. It's a bit too deep for my mind.
Yeah.
But they called DeepMind.
Yeah.
And they acquired Google acquired them in 2014 for about $500 million. So they were pretty early in terms of the AI race. I mean, at the time, I don't think it was really a race yet, not the way that it is today. So they invested in DeepMind, so acquired them and built them into their company. So for some people who invested early in DeepMind, it could have been an exit. But for those who stuck around, it was basically an investment. Like, okay, now we've got this investment from Google. Google's now going to be a partner of ours. We're going to be building things that are going to feed directly into Google's infrastructure, which you can imagine is already super huge. So that's a big benefit for the startup.
Yeah.
More recently, Microsoft has partnered with OpenAI. And so they've invested in OpenAI. So Microsoft owns a portion of OpenAI to the tune of $10 billion, which is pretty massive.
Significant investment.
Yeah, right? So you can imagine as a startup, if someone comes and says, I'm going to put $10 billion into your company.
A lot of money.
It's a lot of money and a lot of runway.
Yeah.
So that's another partnership. So Microsoft positioning itself, bringing on board OpenAI, who brings you ChatGPT, Sora, all these other sort of AI functions, and bringing that into Microsoft's ecosystem. So now Microsoft can roll out things like a Copilot in Microsoft Word that's powered by OpenAI. So they don't need to go out and independently build this AI because they've got that synergy from the investment that they've made. This is also playing out again with Amazon. Amazon just invested $4 billion, or they're going to invest over the course of time, $4 billion in Anthropic, which is another AI company which brings you Claude, another large language model. So you can see it's a company that's really well positioned already in the market, or maybe wants to be better positioned in the market, and it sees a strategic benefit in this company, this startup, and says, I'm going to invest in you, I'm going to acquire you. Typically, the way I've seen this work out is you could, as the investor, now have access to the intellectual property of the startup. So if I'm Microsoft and I've invested in OpenAI, I could get access to OpenAI's intellectual property, the proprietary knowledge that they have about how they're building their systems, which is really cool for me because I now have an edge on my competition. But for the company, the startup that we've invested in, they also get the benefit of a lot of money, but also now they have broader reach. So if Microsoft invests in you, you have access to all of Microsoft's infrastructure.
Well, if you agree to that, yes, they could just invest in you and not allow you to.
That is true.
Into the door.
It could be one-sided.
Exactly.
But you can imagine a situation where you're getting the benefit of Microsoft's knowledge, the networks that they have, the connections that they could put you in touch with. So there could be a lot of synergies on both sides. But of course, it depends on the type of deal that you negotiate.
Exactly.
So that's sort of the corporate venture capital space or the strategic investment space generally. I think that covers it. Is there anything else you wanted me to cover there? Otherwise, I was going to talk about crowdfunding.
No, before we even speak about crowdfunding, I wanted to add something regarding competition law regulation.
Good point.
This tends to be one of the areas that is usually on high on the radar of a lot of competition regulators, for the reason that sometimes these acquisitions could be predatory. Rather than being strategic, they are predatory in nature.
How do you mean?
Yeah, in that the big established corporation sees the potential, but equally potential for threat.
Yeah.
in this startup. So you have a good idea, but they're equally recognizing that if we continue with our business model or innovate as we're planning to do, and this startup grows significantly, they will actually kill our business. Rather than being competing business models, there's a high likelihood that this particular business could take us out. So what you decide to do is you go for a strategic investment and acquisition of equity, so that you have more control in this particular startup, because at that stage the startup needs capital. It's wholly an idea. So sometimes these strategic investments may be considered as predatory acquisitions under competition regulation, and some regulators may actually punish or even prohibit the acquisition of or investment in that particular startup.
So it's something you need to be on the lookout for, especially, I mean, really any deal that you do. Odds are, if it's a strategic investment of this sort, you will need typically some sort of regulatory approval from the competition or antitrust body in that given jurisdiction. So it's something to always be on the lookout for. Here in Kenya, we have the Competition Authority of Kenya. Uganda's recently passed the Competition Act that now also tries to regulate that space and provide sort of guardrails or rules for the road when you make that type of acquisition. Because previously there really wasn't. That in Uganda it didn't really exist. But it's now also something that's being rolled out. We have COMESA, a regional one for the common market for East and Southern Africa. So there are different bodies that you need to be looking out for within the continent, depending on where your deal is, where the acquisition is and the target, if they have subsidiaries or activities in other states on the continent. So again, talk to your lawyers.
Exactly. Talk to your lawyers.
You don't want to sign a deal and think it's done, and then next thing you know, you're getting a letter saying.
And more preferably, talk to us. So I just wanted to add that. Of course, we could go into a whole episode regarding the competition considerations, but that's mostly for maybe a little more mature companies. But still, because competition law evolves to respond to the prevailing economic or commercial circumstances, then there's a bit, the law is equally starting to evolve to start to look into some of these acquisitions and what implications they have. Actually, there was one that COMESA COMESA reviewed a proposed acquisition in the taxi business in Egypt. And despite that transaction not reaching the threshold levels that are required for you to notify a transaction to the COMESA Competition Commission, the CCC, the COMESA Competition Commission, actually prohibited the deal from proceeding for the reason that it was considered to be predatory. Like, despite the fact that you do not have the numbers in terms of turnover or value of assets that would trigger the notification, then this acquisition, from when you look at it closely, it's likely to kill a competitor at the very nascent stages. So
interesting.
So those are some of the things you would expect, of course, with investments or acquisitions at the early stages of startups, and indeed parties would need legal advice on that. So perhaps you could take us through crowdfunding, Adrian.
Sure. So crowdfunding basically involves raising small amounts of money from a large number of people. It's typically on an online platform of some size, some sort of website or an app. The thinking being angel investors, PE investors, VCs, they have access to these privately held companies that are pretty early in their life cycle and that could go on to grow to huge value. So if you get in early, you make huge returns. To get into that investment space, you typically need to be a sophisticated investor, a qualified purchaser, that type of thing, which usually the VCs and PEs and their underlying investors are, or your angel investors. But for, the regular person, the wananchi, mom and dad, you've made your money some savings and you want to invest in this type of thing, right? Crowdfunding is typically the way that people are able to access this type of investment class if they're not yet a qualified purchaser or a sophisticated investor. So the way it usually works is the online platform aggregates funds from many people so that it can make a single investment in one of those companies.
Yep.
Typically, if you're making these types of early stage investments or even PE later stages, the investment amounts are quite large, right?
Yep.
So let's say $100,000 upwards. An individual might not be able to afford that, but if you get 50 people together, they might be able to afford that. So that's sort of the thinking. There's economies of scale. You get people together, take their money, and then invest. And then, of course, the returns are also then pro rata distributed amongst those people. The big caveat here is that when it comes to crowdfunding, it's and rightfully so, it's heavily regulated.
Exactly.
Because the last thing you want to do, the reason that a lot of regular folks are not allowed in this investment class is because it's really highly really, really risky.
Or you don't even understand the asset class.
Yes.
You don't understand the risk because, for example, like we provided statistics in episode 2 of the podcast about what numbers show the success rate of, startups, and the numbers are between 10 to 20% of the startups will make it to success. So, but you may not understand that if you're not delved into how startups operate, how the ecosystem operates. So, of course, the regulators need to protect members of public who may not, who may just be more excited about the potential return,
and not the risk,
and then the risk. So you go and get all your pension. Somebody told you this could turn 20 times over. You could get a return of 20 times your investment. So you retire, take all your pension, put it there. You forget that you have to give it time. So, 2 months down the line, you're asking
where's my money?
Where's my money? Where's my 20 times over? Yeah. So of course,
the
regulators have to really protect that. But even as they protect that, I think the challenge is to the people, largely the market as well, to educate themselves.
True.
Because the regulators can only protect you as much. You see, there is regulatory protection, which also stands possibility of growth, because you would want the market to understand these asset classes much more deeply, which benefits the economy at large. Because if people have a good understanding of options they can invest in, you're not just limited to real estate, you're not just limited to securities exchange where you buy stocks and hold on to them and wait for dividends, or you're not just limited to government securities and bonds. There are other areas of investment that you could make that could give you good return, but they require you to invest in understanding. So I think it's a challenge as well to the continent largely, because we have a lot of restrictions within the continent for such asset classes for a good reason. But equally, I think we would do much better if there was more broad understanding of this.
I agree,
asset class.
And I think that's also part of the reason why we're doing this podcast, right? Because we want to make sure people understand what's out there. I mean, of course, if you're going to start your startup, we want to make sure that you're well equipped to do that. But even as an investor, if you're looking to put your money into something, hopefully all your money isn't sitting in a savings account being eaten by inflation, right?
Exactly.
Hopefully you're also thinking about different investments that you could make that could grow that money over time and hedge against, the deterioratory effects of inflation over time. So
exactly,
just another consideration. So just to, I guess, put a fine point on this, that crowdfunding is really, really risky, especially on the continent where we're still getting to the point where we're creating a solid regulatory framework around that type of thing. But I do know at least of a few that are starting to come up. I think there's Thunder Fund in South Africa. I think here in Kenya, there's one called Mchanga. I've never really interacted with them, but I just looked.
But I think those ones are more like they probably deal with social events, social activities, like somebody who's...
So like you crowdfund for a specific event?
Yeah, like, maybe somebody is unwell, they're supporting.
What's it called?
But I have to be honest, I haven't delved into, gone deeper into what Mchanga does, actually.
This is a Crowdivest in Nigeria. You mean like... What's that? There's a word for it, the Swahili word, when you get together to contribute for something.
Harambe.
Yes.
Well, maybe it's a form of harambe, but being done online. Yeah,
harambe is a ras.
But that's actually, crowdfunding is basically a harambe, but perhaps sometimes for big return.
Interesting. So it's funny when you go for a harambe, I guess that one it's more for a specific cause. It's not like you're investing to get a return. It's that I'm giving because someone's unwell and we're coming together to put money into this. But it would be cool if people could have a Harambe to invest in a specific initiative, right?
Yes.
Like an investment opportunity. You walk through the door and you sign reps and warranties.
You know what? I like
saying I understand.
No, I actually like that idea.
Yeah.
I'll tell you why I like it.
Why?
Because it could be the beginning point of explaining some of these investments.
True.
By explaining to the masses and as to the masses what they understand. Harambe. You just contribute something, it becomes more. If you're raising 2 million, you send your 50K, somebody sends their 2K, somebody sends their 50 bob. Ultimately we get to the 2 million.
Sure.
So then after we have done that, what do? We proceed to invest. Now, I think that could be a good starting point for that kind of conversation, because I think the work is cut out for regulators such as Capital Markets Authority, because they also do education of the population regarding financial sensitization and what investments they can do. But I think that could be a good pickup point.
And I think it's also growing in other ways. I've seen investment clubs or investment. So, for example, people I went to school with, we get together and we say, everyone who graduated in this class, well, first of all, we have a WhatsApp group. So we have banter and all these things on there. But now we're saying, guys, we can't just keep bantering on here. Let's do something useful. So then we get money together and we form an entity and we say everyone's going to make contributions to this entity. I think initially we will put it in safer assets, quote unquote. So treasury bonds, things like that. And then down the line, as everyone is keeping up with their contributions and now we've amassed a certain amount of money, we can now start saying, okay, maybe we want to diversify and go into other types of investments. So I think people are starting to coalesce around these ideas in themselves, but it's good to also give them the structure of what's already out there and what are the more structured and regulated ways that this is already happening.
Exactly.
So anyway, that's crowdfunding. And we're not recommending you go and invest in a crowdfunding or a crowd fund. I just wanted to enlighten you as to another type of investor or investment class out there. So, Tim, I think maybe you could cap this conversation with talking about accelerators and incubators, who we also have spoken about in a previous episode.
Yes.
But maybe you can just enlighten us about how they go about investing.
Yeah. In one of our previous episodes, we had a deep dive on accelerators, incubators, and venture builders. But equally, they also honorarily investors in startups. Either they could invest resources or they could invest capital, or they could invest knowledge, mentorship.
Things,
Exactly. There are some of the investors, and sometimes they do actually acquire equity stake in the particular startups they invest in. So for more details on who accelerators, incubators, and venture builders are, we propose that you have a look at our previous episode. I think that should be episode 7, but please have a look at that, where we delve deeply into who they are and what they do. But there are also some of the investors in startups and businesses. So Adrian, perhaps you could VC and PE funds, despite being investors in startups or in businesses, equally have people or institutions invest in them. They do raise money from a source for purposes of investing, and it's actually good for a business owner or a founder to understand how exactly venture capital funds or private equity funds raise their money, and what is expected from the capital they raise. So to understand what returns or what reward or returns that the VC or the PE fund is looking for. So perhaps you could take us through how PE funds and VC funds raise capital.
Recall that VC and PE funds are pooled funds, right? You've taken capital from sources, you've brought it together, and now you're making those investments through the fund into a startup or a mature company or some other sort of investment. So those funds have underlying investors that contribute money because they expect returns. So you can think of it as we set up a fund, Tim and I, and we go to all our friends and we tell them, trust us, Mimi not sure.
Mimi not sure.
We have done investments. We know what this space is about. Give us your money. We're going to put it together with money from 100 other people, and we're going to go off and make investments. And as those investments are made and they make returns, we'll then return to you profits. So that's sort of the structure, whether it's a VC fund or a PE fund. So who those people are that invest in PE funds and VC funds, it varies, and I'll go through a few of them. But what they're expecting are returns. Like that's it. I mean, they could invest in a PE fund that's geared towards social impact, or some economic or social, empowerment and development. But at the end of the day, if their money goes in and doesn't come out, it's usually not a success. It's usually not a successful investment. So they are investors in a fund, and that fund is then also the ultimate investor in the startup. So it's good to just understand that those people exist, and it's their money ultimately that's driving this. Of course, the fund manager also contributes a certain amount of money.
Yes.
But it's really those underlying investors that have made the contribution that is now sitting on your balance sheet. And so you owe the investor as the fund returns, but the fund itself also owes those people returns. So all the more reason why they're looking to make money out of this, this investment in you as a startup. So who are the types of investors that invest in PE and VC funds? So largely, it's usually institutional investors. Institutional investors are basically large pools of money, or it's an institution that has large pools of money.
Yeah, I like that word. An institution.
Yes. So it's not an individual. It's an institution. So let's say, think of an insurance company. Insurance companies typically take premiums from people. And those premiums are pooled and they sit together. And then when there's an event that a claim that's been made that needs to be paid out, they then pay out of that pool of money. But what is that pool of money doing when it's not going out to pay claims, right? It needs to be doing something. So typically they'll put it in some safe asset class, mutual funds, treasury bonds, things like that. But they'll also make bets on private equity funds, VC funds, so that that money continues to grow over time. So insurance companies, think of endowments, basically commercial banks, institutions that have a lot of money sitting around that could be doing something while, instead of sitting in a bank account, again, say it goes to the point of your money sitting in a savings account, it's sitting there, and next year, 10 years down the line, even if it's the same absolute amount of money, it's going to be worth less because of inflation over time. So it's better used by those institutions if they put it in different investment classes that can grow that money over time. So their objective as an institution of investors is usually just to diversify their portfolio and make sure that their money is growing over time. Those are institutional investors. We have development finance institutions, DFIs. Those are usually agencies or institutions that are run by a specific country. And their goal is more economic development. So it's in the name, a development finance institution. They're financing development of different regions, different people, different economies and sectors. Examples of those, you have your IFC, African Development Bank, FMO, which is the Dutch DFI, Proparco from France, Norfund from Norway. I think people are a lot more familiar with DFIs because they do operate in this space a lot more, especially they end up being a lot of the investors in private equity and VC funds that are focused on the continent, because they see that this is an easy way for them to actually, well, not easy, but it's a more direct way for them to make an impact or to contribute to social and economic development. Because the fund is already going to be investing in startups in the region. You also have sovereign wealth funds. Sovereign wealth fund is more like a fund that's been started by a sovereign,
like a country.
Thank you.
It's owned by the state.
Exactly. So you think of, I think PIF is probably the most famous one at this point because they've made so many investments. PIF is the Saudi sovereign wealth fund. So you see a country that has a lot of reserves or has a lot of money sitting around that we could be using for something. I think the sovereign wealth funds from the Arab part of the world, they are more focused on diversifying out of, say, oil, for example. So we've made a lot of investments in oil, and oil is making us a lot of money. But in the future, maybe the world is moving away from extractive resources, and we need to find a new way of making money and a new way for us to have power and position as we go forward. So we set up this sovereign wealth fund that has our money in it, our reserves, and then we go off and deploy into private equity or venture capital funds. We've seen, I'm pretty sure PIF has invested in some of the biggest startups that have come out of the US and that have gone on to do really big things.
Yeah.
So we have PIF, ADIA, QIA, which is a Qatar Investment Authority, Kuwait Investment Authority.
Yeah.
So there are a bunch of those different ones. The other investors in PE and VC funds are high net worth individuals, which we've already covered them in sort of the angel investor discussion. So again, high net worth person has money, wants to make investments either for financial return or for social good, and they invest in a PE or VC fund. They are sophisticated investors by definition, and so they are able to qualify to invest in a PE fund alongside institutional investors.
Exactly.
We also have family offices. Family office just being an office, a specific investment vehicle that has been set up for a family or for an individual, a group of individuals to make investments on their behalf. So you can think of Bill Gates has Cascade, which is his family's investment vehicle. Jeff Bezos has Bezos Expeditions, which again, similarly. So if Tim and I were, let's say Tim was really, really wealthy, Tim could have
one day.
So one day, hopefully, you will have a family office, which will be the Mukiti family office.
Yeah.
And your family basically will have all of their, a significant portion of their wealth managed by that office. So you hire investment professionals and they go about deploying that capital into things that could make returns. So usually private equity, VC, as well as other investment classes. We also have foundations and endowments. So, I mean, I think these are pretty self-explanatory, but it's, again, pooled money that's dedicated to a specific thing. In this case, it's usually social good or philanthropy. In the case of foundations or endowments, it's for the development of that specific institution or for the longevity of that institution. So Harvard has an endowment, Stanford has an endowment. Usually it's schools or large educational institutions. They usually have an endowment that's funded by alumni, people who love the school. And so now that money's sitting around, and again, we want to use it for something good or for something that's going to create returns.
You'd want it to get returns for purposes of serving its mission, because the more the pot grows, the better that it's going to serve the intentions that the fund is set, the endowment fund is set up for.
Exactly. So you'll see a philanthropic organization making an investment in a PE fund, and you're like, well, I think you're supposed to be putting your money into
charity.
Yeah, but you say if we put all the money into charity, then the money's gone. But if we put some of the money in this investment, then we'll grow and we'll have even more money to put towards charity.
Exactly.
The only other one I think I'd flag is fund of funds, which is more of a technical one. It's basically where an institution, like say a bank, goes to its high net worth individuals and it says to them, I want you to, or I'm offering you this investment opportunity. I'll take your money and pool it with other high net worth individuals. We'll create a small fund, and then that fund will go off to invest in a private equity fund. So it's a fund of funds that makes an investment. So again, super high net worth individuals are usually the ones who are involved in this type of investment. And you do need to be a sophisticated investor, or qualified purchaser, or you need to hit a certain threshold before you can make that type of investment. So I think that's is there anything else you wanted to add? Because I think we've now covered all the investors generally that invest in startups, as well as even within those investors, who are the people that invest in them, specifically who invest in PE and VC funds.
But what I wanted to add from what you've explained is that despite this being investors that put funds into VC funds or PE funds, sometimes they also directly invest in startups.
True.
For example, some DFIs like No Fund will invest in an asset class that is considered a playing field for PEs. So they may go and acquire. Basically, it would be a private equity kind of investment, but done by a DFI like No Fund.
Sure.
We equally have a sovereign wealth funds like Mubadala that has invested, and we will be discussing this in the next episode actually, where we'll go into a deep dive on the transaction Move. Mubadala actually invested directly in Move.
Mubadala being a sovereign wealth fund.
Being a sovereign wealth fund. So despite the fact that they invest directly into the funds such as VC and PE funds, they equally occasionally do make investments directly into some promising startups. So,
it's occasionally, right? It's not as often, but
Exactly.
sometimes in some cases they do find the need to make
in
those
highly
investments.
promising startups. So that's
okay.
That's an addition. Yeah.
So I think that covers what's an investor, what are they usually trying to get out of their investment, what are they looking for, who are the different types of investors, and even within those investors, who invests in them. Maybe now we could just cap the conversation with a few insights for founders specifically. When it comes to the investors that they're dealing with or that they're seeking investment from. Maybe you could start us off with just any insights that you want to flag for our viewers in that space.
So arising from our discussion, so basically about the investors that make investments in startups or businesses as they grow. Some of the things that would be essential for founders to understand, and that would be useful in terms of engaging this conversation with the investors, include things like a term sheet, setting out with clarity what the business parties are trying to achieve with that particular transaction. It's useful for parties to understand what they are hoping to do. Another one is, due to the character of investors and how they put in money, some of the considerations include most investors will put in capital with the intention of exiting at a future date. As a founder, maybe that is your goal, or may not be your goal, because some founders want to stay with their business in perpetuity. Others want to exit at some point. So it's good to know the investor maybe would be looking for an exit strategy at some point, and you have that in mind even as you're negotiating the investment or as the investment is coming in. So others include investor alignment beyond capital. I think we have already mentioned that you need to understand what is the driving focus of your investor. Is it that they are trying to make an impact, or is it that they are trying to build significant returns, or is it a strategic sort of investment for the investor? So you need to be aligned beyond the capital coming in, because that's crucial for the business. Of course, communication is key. With some of the investments, there will be higher requirements for you to make reporting to the investors. And you need to ensure that you're providing good communication as soon as possible.
And sometimes that's I think a function of the underlying investor. So maybe that's a good point to flag there as to why you maybe need to understand who is investing in the PE fund. If the PE fund has a lot of DFI investors, the development finance institutions, they usually have a lot of policies and restrictions as to the types of investments that they need to make, the ESG requirements, the amount of social good they need to be having or making, the requirements for the types of people that will be hired by the company that they're investing in, that type of thing. So that flows through, because now the PE fund, the investor, the DFI tells the PE fund, I need you to report to me on a regular basis about these metrics, because these are important, and in our internal policy requires that we report on this. So you need to report to me about that on a regular basis. So the PE fund then in turn comes to you as a startup and says, we need you to be reporting to us on a regular basis about these things, because we have people that we need to be reporting to. So it's not necessarily that the PE fund just likes to get reports. Which I think there's usually a lot of friction sometimes between investors and the
founders.
Because the founders are trying to get the work done of running the business.
And now they have to do reports. Every 3 weeks you're working on a report, but you have to understand, because it's important to understand why these reports are needed, and if you don't understand, ask. So that's why we're saying communication is key. First of all, understand what the investor is hoping to achieve, and also communicate what you're hoping to achieve, and see if you can be you could have an alignment.
And communicate both the highlights and the lowlights, because sometimes you might be just telling your investors the things,
highlights,
but then you're not communicating the things that are going wrong, and
then they just suddenly hear somebody has taken you to court. They would want you to be liquidated.
That could degrade the trust between the investor and the founder.
Equally understand the investor motivations. What is motivating the investor? I think we have already discussed that point at length when we mentioned what intentions the investor might be having, or what could be driving them. We also have smart money versus patient capital. Smart money basically refers to investors who bring value, such as knowledge and industry connections, and their value add to the business. So you need to understand whether the money that is coming to you is smart money, and you might be specifically looking for smart money because it comes with a bit of sort of let me not say mentorship, but you get the gist. Sort of value add in terms of how you're running your business. Patient capital, on the other hand, is capital that is willing to wait longer for returns. Private equity tends to be a lot more sort of patient capital because
at
you
least
need
in the 4 to 6 year
exactly
range.
It's a little patient compared to perhaps if you're investing at seed stage and you're looking forward to exiting at Series A. So the moment the business raises Series A, you're on your way out. So again, for the investor, they need to understand what this capital hopes to achieve. And how it's going to be done, whether it's playing a long game or short-term game. And
I think that's something that on the continent we need more of. We need more patient capital because also within the continent, sometimes things take longer to play out. So in the PE space, I've seen it be a bit of an issue in the sense that private equity funds are typically structured as closed-ended funds, which means people come in and the fund has a limited life. So let's say 10 years. So the first year 1 to year 6, we're making investments. And then year 6 to year 8, 9, we're exiting those investments. We're trying to unwind ourselves from those investments so that we can return money to folks. And then by year 10 or so, we're just, we're dissolving the partnership and we're moving on to something else.
You're already actually raising another fund.
Yeah, probably you've already raised the other fund from like year 3, 4, or 5, maybe after the investment period has ended.
Yeah.
So it's one of those things where if the fund is structured to make investments from years 1 through 6 and then start exiting, if they get to year 6 and their first investment is just starting to show promise now, they're in a bit of a bind because they have to exit that investment as a private equity fund. That's how it's structured. So what do? They could sell it to another fund, another private equity fund, and maybe that private equity fund is now going to see the real growth and they're going to benefit from it. So it's a bit of a loss for them. Or maybe they have another fund that they've set up and they try to sell it to that fund.
Yeah.
Or
which would work much better if they have another fund. But then the thing is,
also
the investors in
issues.
that fund may be totally different from the investors in the fund that made the first investment. So somehow there will be some loss somewhere.
There are issues also because you're dealing with yourself on the other side. So there may be conflict of interest issues because you're in fund 2. Maybe fund 2 investors want different exposure, but they're seeing you investing in the same thing as in fund 1. So if I wanted fund 1 exposure, I would be in fund 1. So there are a lot of different issues that come out there. I've seen it dealt with sometimes. People make these permanent capital vehicles where it's like a private equity fund, but it's evergreen. It doesn't have an end date, so people can come in and they can leave. It's similar, more closer to a hedge fund than a private equity fund. But there are different ways to solve for it. But all to say that on the continent, we do need more patient capital.
Yeah.
And sometimes the structures for private equity specifically are not designed to be that patient. It's more, we need to get in, we need to turn this company around, and we need to get out.
Yeah.
I think VC sometimes has a bit of a longer runway. They might be staying into an investment a lot longer, depending on how they're structured. But even your angel investors, someone might come in and invest in you, and you think they're patient and they're ready to stick around for the long run. But then a year later, they say, by the way, I need my money back.
Yeah.
So
we need to be thinking, we need to be, prompting an exit event.
Yeah, right. We need to take, I think, more of a long view on the continent. And this plays out, I think, in that as well as other things we've talked about, right? It's like you're talking to someone and say, bro, give me a good deal. We're going to be together for a long time.
Yeah.
So let's take the long view and make sure that we're working towards a long-term exit where we're all going to make a lot of money down the line.
Yeah.
I think that's sort of what I wanted to touch on in terms of patient capital.
That's a good addition, actually.
Okay.
Yeah. So other considerations we could have include, understanding the right time to raise capital. Timing is key because. But then when we say timing is key, I mean we also have to appreciate the capital demands of the startup. You know. Sometimes you're really under pressure to raise capital to keep the startup going. But even then, try to sort of identify the right timing because at the right time, perhaps you would raise way better capital that comes with maybe, strategic value added to the business. So those are some of the considerations. Actually, it's important to raise capital when you have leverage. But again, we say this with the understanding that sometimes you can't wait to get the leverage. You're under significant pressure to raise, to actually keep the lights on, to keep the business going.
Pay people.
Exactly, pay people. You can't say, okay, fine, guys, let's sit it out. You guys wait for your salaries until next year. I'm thinking of fundraising, and So we have to appreciate the dynamics, of course. But if you're able to fundraise at the right time, then it adds value to you.
Just only thing I wanted to add there was we mentioned in a previous episode, we talked about, we raised the point that you need to understand the runway for how much time should that money last. So if I raise now, when's the next time I should be raising? How long should that money last? And it's funny, we didn't actually get to how long you should expect that to
you
last.
mentioned we would get to it.
So I think we should maybe just put underline that here in the sense that usually it's 12 to 18 months, I'd say, at least between, like, let's say your seed and Series A, or Series A and Series B, or your post-seed, whatever you're doing in between.
Ideally.
Yes.
You could actually raise capital 2 months later or 3 months later.
Yeah.
But ideally.
Because then it's odd, right? If you just raise the Series A now, and then 2 months later, you're telling me you're raising Series B. So either there's a bit of a misalignment there, because the expectation was that this Series A money was going to take you down the line for, let's say, another 18 months, to the point where you've now scaled enough that you need Series B money, and you're looking at a different types of investors. You're bringing in more investors. Maybe your earlier investors can also come in for another round, that type of thing.
And the valuation, of course, has started to look different.
Exactly.
Because if you're fundraising 2 months down the line, so what
What's
value
changed?
What has changed? Yeah, exactly. So around that time, there's been perhaps 12 to 18 months. There's been a bit of traction. You can see. But anyway, that's the ideal. But if you really need capital, find ways to raise it. Whatever time.
A2.
Yeah, we could do a Series A2, Series A3. So I think perhaps to add 2 more points of what you might want to be in the lookout for. Be prepared for the due diligence. Prepare for DD, because
it's a huge one.
The investors would want to undertake a DD to understand your business. It could even be a DD on the founders themselves, DD on the business, a DD on the market, a DD on competitors, depending on what the investors are looking for. So you have to have your ducks in a row. If you're looking towards fundraising in future, or you're a founder that wants to raise capital at a future date, then you have to understand DD will be part of it. And if you can put your house in order early enough so that your DD is not flagging everything. I mean, your DD report is not all red. They've carried a DD and there are serious issues which could have been avoided, which takes me back to another item that an investor needs to be aware of, is cap table management. Because, of course, that gets flagged during a DD.
So who owns this company? What's on? Who's on the cap table?
Who is on the when we say cap table, we mean the shareholding structure. Who holds how many shares? Who is invested? Who has a right to convert some loans into equity,
or
into
saves.
shareholding, or saves? That needs to be well managed.
And immediately clear just by looking at it. Because if you look at it and you don't really understand what's going on, that's again a red flag.
Do you want to add something on that?
Maybe the only thing I'd say is also, even the investors who don't invest, I think it's worth keeping in touch with them and just keeping them posted, even if things didn't work out, just to make sure you maintain that relationship. Because again, as we mentioned, all these investors pretty much know one another. Or the circles that they run in are pretty small. So just because you don't receive investment from someone, it doesn't mean that they won't come in down the line at a different round, right? Maybe
put in a good word for you.
So maybe they couldn't invest at the time for whatever reason. It's not because your business isn't a good prospect. It's because of other things. So maybe they could be the source of your next round of funding, or they could be a mentor. So I think not burning those bridges as you go, I think, is also very important.
Okay. So do you want us to give us some wisdom from the course?
So
what wisdom do you have from the course?
We're done with the serious stuff. Okay. Wisdom from the course. For this week, the lesson is around integrity and honesty, and how that plays out in the game of golf. So golf's a game where you learn a lot about yourself, but you also learn a lot about the people you play with. It's funny, you're the one who first actually told me about this before I'd even started playing golf. You said something like, if I play with you, if I play with someone and they lose their ball in the grass or in a hazard somewhere, and they go and then they claim, oh, actually I found it, it's here, but they've just swapped it for another ball. and you see something like that happen, you get the sense that if you're willing to be dishonest about a game of golf, what else are you willing to be dishonest about? And what does that say about this person?
What else will you cut corners about?
Yeah, and golf is a game where a lot of the time you're trusted to be honest, right? You keep score. You say, "Oh, this is what I scored," and you'll keep score with someone and you'll exchange cards. But I could tell you I shot a 4, yet I shot a 7, because a lot of the time we're separated. You tee off together, but then everyone's ball goes somewhere different. Especially us amateurs who our balls the dispersion
flying
is
all over.
So we could start the hole, and Tim and I are together, but most of the hole it's me with my caddy somewhere else, and Tim's completely in a different area. So I could mess up 3 shots there where the ball barely moved, but I say, you know what? Tim didn't see, no one saw, so I'm just going to write it as a 1 or a 2 or something. So I think golf shows you things in other people, but also in yourself. And I think it's important, especially when no one's looking, right? I think that's when your character is really tested. When no one's looking, no one's there to keep score. I think that's when it's most important to be true to yourself or to your values.
Yeah.
So I guess when no one's watching you when you're playing, as well as in real life, when no one's seeing you, what is it that you're doing then? And trying to make sure that, especially during those moments when no one's there to hold you accountable and no one's seeing what you're doing, to make sure that you're being true to yourself and you're upholding the values that you believe in. That's something that I think really plays out a lot in terms of golf, and something that it shows me in terms of real life. So having integrity and honesty, especially when no one's keeping score, is super important. And I think we should try and work on that. I mean, I try to work on that on myself, but golf shows me that every time I go to play. Yeah.
Indeed, that's a good one. That's a good one. And it ties to even, founders when they raise capital. Are you going to be honest on your deck or when you're fundraising to explain actually what or to explain exactly what you're doing, or you're just going to be changing the pitch deck to suit the particular investor, and you just want to tell them what you think they would want to hear, and then once they've come in, you're totally going in a different direction. Even as the reports that we've mentioned, when you need to provide occasional reporting to the investors, are you going to be very honest, upside, downside, or you're just telling them the ones that have gone well, and they need to have a proper view of the business.
Everyone, even investors, especially in the private equity VC space, a lot of the times when you're marketing to your potential investors, they need to see your track record. They say Tim's raising a fund, but what's his track record been in the past? So you could go and maybe you've made 10 deals before, and 2 of those did really well and 8 of them were really bad. So maybe you just write the 2 deals, like, oh, I did these 2 deals, and these were you cherry pick and you say these
exactly.
That's a bit dishonest in the sense that you're not giving a full picture or representation to your investors, and they could rely on that information to then invest in your fund. So across, even as your investors, your founders, wherever you fit in the ecosystem, I think that integrity and honesty is quite key.
Do you want to add what interesting thing?
No, how about you go first? Tell us your interesting thing of the week.
The interesting thing for the week for me was on Wednesday. I looked at my emails, realized that there wasn't something that was urgent that I needed to attend to. Or something that I hadn't delegated already. Perhaps something that was happening at the registry. So I decided to go to Ngong Hills to just, take time to reflect and, take some time off and just reflect. So I drove to Ngong Hills. It was actually very quiet. I think we were I only saw 3 cars, mine included. People parked at different spots. Yeah?
You want to describe Ngong Hills for people who've never been or
Ngong Hills
is
one of the hills that is not far from Nairobi. With very nice views. Honestly, it's hard to explain it until you see it.
Just Google it.
Yeah, just Google it. So I went and parked at some spots, and so one side of Ngong Hills actually slopes into the Rift Valley.
Okay.
Yeah, it's Ngong Hills is situated at the edge of the Rift Valley. So I parked on the side where I was having a view of the Rift Valley, and I spent some time there. So some point, I started wondering, how long has the Rift Valley been around for? You know, it's gorgeous. The view is beautiful. But I started asking myself, when did this happen actually? You know, when did the Rift Valley form? And I Googled and I realized that, okay, the records were saying it formed between 25 million and 30 million years ago. Now, that made me feel small. Really, really, really small.
Yeah.
So small because for the time that I've been alive, I can't even form 1% of the time between, you know, that the time when Rift Valley formed. And then I thought, how many people have stood where I'm standing now and taken in the view of Rift Valley? Perhaps generations and generations.
Yeah.
Some of them are not even in the records of the history.
Mm.
And what that made me realize is that we are really here for a very small space. And there is so much beauty to take in. But we should equally be so grateful for the opportunity to be here for that very brief moment. I guess 1,000,000 years from now, some random guy will be on Ngong Hills. He will stare at Rift Valley and he will do a research and realize that Rift Valley has been around for about 26 to 31 million years, you know. And I wonder what that will make them feel. But yeah, it made me realize it's really a beautiful thing to have this opportunity to be in this space at this time.
Yeah.
Because Mother Earth will still continue for a while.
That's true.
Exactly.
1,000,000 years, people might not even be here to appreciate it. But the Earth will probably still be here.
Exactly.
Yeah, we're specks of dust on a rotating globe in one of many and many universes. And very, very good, very interesting one. Thanks for flagging that. Reminds me of how small I am in the grand scheme of things as well.
Small but not insignificant. So the thing is, we are small, but we are not insignificant. We have a lot of significance at our present time in the universe. So,
it's very deep, Tim. Today you've come with the deep stuff.
Okay, what did you learn did you learn this week? What's your lesson for the week?
For the week is, again, a person. Because I find people so fascinating and the things that they do. Mm-hmm. This one is, I don't know if you've heard of this, the Nigerian chess master in Times Square.
I've heard of that guy. Yeah.
So his name is Tunde Onakoya. Steve, have you heard of this? Tunde Onakoya. He's, as of yesterday, he was trying to break a record, Guinness World Record, for the longest chess marathon. So the terms are, he has to play in the open air, so people have to be able to watch and all of this. So he's doing it in Manhattan. Honestly, someone who's been in Times Square, I don't know why he would pick Times Square. Times Square is like the most touristy place with so much going on. Yeah, I would rather somewhere more quiet where I can actually focus. But anyway, I guess probably part of it is a spectacle. So he's 29 years old. He's in New York City for the first time, and he's trying to break the world record, which is 56 hours. That was set in 2018. So goal bigger than him, bigger picture. He's trying to raise money for the Gift of Chess and Chess in Slums Africa, which are organizations that promote chess and use the game to lift children out of poverty. So it's a really cool cause. It's not just that he wants to do this and he's just doing this out of his own vanity or anything. Yep. He says, I'm playing for the dreams of millions of children globally without access to education, which is so cool. The fact that he's using this game, a game that's so interesting. I don't think it's probably not as widely played on the continent as maybe it could be. Yeah, I think there's been other things that have come out in entertainment that have shone a spotlight on chess. I don't know if you've seen Queen of Katwe. It's about this Ugandan girl who became like a really good.
No, I haven't watched that.
She's really good at chess. Lupita's in that movie. You should actually check it out. Oh, okay. Also, Queen's Gambit on Netflix, but it's just, again, a cool African person doing a really cool thing. And his goal is to raise $1 million over the next 3 days. So I've been seeing clips of him in Times Square playing. People have been coming, Africans, people come on and they're partying, they're playing drums, music. Davido showed up randomly. I guess he was in New York. So he showed up to show support to his fellow Nigerian doing this. So
when you're playing chess, you don't really need people playing drums.
That's what
I mean.
So I'm amazed that he's doing this. Yeah. And I guess it also has this African spin to it. Yeah. The terms are he's playing 2 consecutive games at all times. One of those is with some chess master person that's really good.
Mm-hmm.
I didn't get his name, but he's playing with someone who's really good at the game. And on the other one, I guess he's playing with whoever sits in the chair. And he has to win every game for that time. He can't lose. So so it's not just an endurance test, but it's also testing his ability to keep winning and to be that good.
Wow, that's a big challenge.
It's so funny. We got here this morning, and so I just checked to see like what's the status, what's going on, because this episode's gonna air way after this has happened.
Exactly.
So I was wondering, maybe the audience will know and we won't know. I just checked. As of this morning, he did successfully win. Like he got to 58 hours, which was his goal, consecutively playing and winning in the open air in Manhattan, and so he's now the holder of the new record until someone else comes and tries to.
That's impressive.
Right?
Yeah.
Amazing. So congratulations to him. Congratulations to Mr. Tunde Onakoya.
Yes.
Amazing thing. And that was the most interesting thing I saw this week. And I think it's just a feat of brain and endurance and just so many different things that come together to make you be able to achieve
especially
something like that.
Playing so many games, 58 hours and winning all of them.
I don't think I've ever done, other than breathing and existing, I don't think I've ever done anything consecutively for 58 hours. And even that, I don't think I won at. So yeah, congratulations to him.
And chess requires concentration. So you can imagine by the 15th hour, you're starting to lose your concentration.
Yeah.
But you still need to go.
And guys are playing Afro beats and all this.
And people coming to play Afro beats and drumming.
And
there.
David was coming to say hi, bro. I would get lost in all that.
Okay, that's impressive.
Congrats to him.
Wow.
Yeah.
Wow, wonderful. Thank you very much. So thank you, audience, for joining us. We have gone through the investors who typically invest in startups, and also investors who invest in the investors that do invest in startups. We hope that you have enjoyed the discussion, as well as the issues that investors need to be aware of in terms of understanding what the investor is looking for, and also what is required for their business. And also equally, we've mentioned a bit about how to prepare for an investment. Equally, we've gotten wonderful nuggets from Adrian on lessons that he picked from the course. And I hope that does resonate or ring a bell in your startup journey, as well as in your investment journey. And equally, two interesting things for the week. Adrian watching a gentleman playing chess to win, and congratulations. And Tim contemplating his existence. Well, I did feel small, but again, the word is small but not insignificant. So we hope
that should be our new slogan.
Exactly. So we hope that you've enjoyed, and we look forward to hearing from you once you've engaged with the content. If there's anything you'd want us to take a deep dive on, you don't want us to discuss further, please let us know so that we can take that into account as we prepare for our future episodes. Until next time, goodbye.
Bye.